Nvidia has agreed to a $20 billion deal involving AI chip startup Groq. But is this a full acquisition? And what does it mean for the future of AI hardware development? How will this move reshape the competitive landscape among chip makers? Let's solve this equation. Welcome back, strategists. This is the Resource Equation, your briefing room where data, capital, and strategy collide. New here? Subscribe for weekly breakdowns of what's really moving markets. On December 24, 2025, Nvidia announced a landmark agreement with Groq, a startup specializing in AI accelerator chips. The deal, valued at around $20 billion in cash, involves Nvidia licensing Groq's Inference technology and bringing on board key executives, including Groq's founder and CEO Jonathan Ross and President Sunny Madra. However, Nvidia has clarified that this is not a full acquisition of Groq as a company. Groq will continue operating independently, with finance chief Simon Edwards stepping in as CEO to lead the remaining business, including its Groq cloud services, which are explicitly excluded from the transaction. Here's where it gets interesting. This transaction is reportedly Nvidia's largest ever, eclipsing its previous record, the nearly $7 billion purchase of Mellanox Technologies in 2019. The $20 billion figure was reported by CNBC and other outlets citing sources close to the deal, though Nvidia declined to comment on the full scope publicly. The deal came together quickly after Nvidia approached Groq, according to Alex Davis, CEO of Disruptive Capital, which led Groq's $750 million funding round in September 2025 at a $6.9 billion valuation. Why does this matter? Nvidia's GPUs, or graphics processing units, have become the industry standard for AI workloads, powering everything from language models to image recognition. Groq, on the other hand, has developed a different type of chip known as an LPU, or language processing unit. This chip is designed specifically for AI inference tasks, that is, running trained models to generate outputs rather than the training process itself. Groq claims its LPU can run large language models up to 10 times faster than traditional GPUs, while using just a tenth of the energy. Bringing Groq's technology and talent into Nvidia's ecosystem could extend Nvidia's reach into low-latency, real-time AI applications. Pause here. Does this make sense? Drop your take in the comments. From a market perspective, the deal underscores the intensifying competition in AI hardware. As AI applications grow more complex and widespread, demand for specialized chips that accelerate inference workloads has surged. Groq reported powering AI applications for over 2 million developers, a significant jump from around 356,000 in the previous year. The startup targets $500 million in revenue this year, reflecting rapid growth amid the AI boom. 3 numbers tell the story. First, Nvidia's cash and short-term investments ballooned to $60.6 billion by the end of October 2025, up from $13.3 billion in early 2020, enabling such a large deal. Second, Groq's valuation nearly tripled from $6.9 billion in September to the implied $20 billion purchase price just 3 months later. And here's the kicker. Despite this massive transaction, Groq's cloud business remains independent, signaling a nuanced approach rather than a simple buyout. Surface level, this deal looks like a straightforward acquisition of AI chip technology and talent. But dig deeper, and it reveals a strategic licensing and hiring arrangement similar to transactions seen at Microsoft, Google, and Amazon over the past 2 years. These companies have used non-exclusive licensing agreements to access cutting-edge AI technology and recruit key personnel without triggering regulatory hurdles tied to full acquisitions. Groq's investors will receive payouts that include earnouts based on future performance, but they will retain stakes in the remaining company. Here's what this really means. Nvidia is betting on integrating Groq's low-latency processors into its broader AI platform, known as the Nvidia AI Factory Architecture. CEO Jensen Huang stated in an internal email, obtained by CNBC, that the company plans to extend its AI inference and real-time workload capabilities by combining Groq's technology with Nvidia's existing GPU lineup. This layered approach could give Nvidia a more versatile AI chip portfolio suited to various tasks, from training to inference. Remember that question about whether this is a full acquisition or just a licensing deal? We're getting closer, but some details remain unclear. Nvidia has not commented on the exact terms, and Groq's cloud business continues independently. Investors and executives are being compensated, but the exact payouts and future governance structures have not been publicly disclosed. Real talk. What's your hypothesis on why Nvidia structured the deal this way, instead of a full acquisition? The broader AI ecosystem provides important context. Nvidia has been actively expanding its footprint across AI through investments and partnerships. For instance, it has backed AI infrastructure firm Crusoe, AI model developer Cohere, and increased its stake in CoreWeave, a cloud provider preparing for a public offering. In September 2025, Nvidia announced plans to invest up to $100 billion in OpenAI, which committed to deploying at least 10 gigawatts of Nvidia hardware. Additionally, Nvidia disclosed a $5 billion investment in Intel as part of a strategic partnership. Other AI chip startups like Cerebras Systems have also made headlines. Cerebras planned an IPO in late 2024, but withdrew it in October 2025 after raising over $1 billion privately. This highlights shifting market conditions and the high stakes for emerging chipmakers in the AI race. Back to our opening question. Here's what we now know. Nvidia's $20 billion deal with Groq is not a traditional acquisition, but a non-exclusive licensing and executive hiring agreement. It brings Groq's advanced inference technology and key leadership into Nvidia's fold, while allowing Groq to retain independence in its cloud business and other operations. This move significantly bolsters Nvidia's position in specialized AI accelerator chips without fully absorbing Groq as a company. Now here's the number that changes everything. Nvidia's cash reserves jumped from $13.3 billion in early 2020 to $60.6 billion by October 2025. This financial strength gives Nvidia the flexibility to execute large strategic deals like this one quickly, reshaping the AI hardware landscape. What comes next? Nvidia and Groq are expected to provide more details to investors and the public in the coming weeks. Market watchers will be following any regulatory filings or announcements clarifying the deal's scope, as well as how Nvidia integrates Groq's technology into its AI platforms. Additionally, developments from competitors and other AI chip startups will influence the evolving market dynamics. How do you interpret this? Who stands to be affected most by Nvidia's move? What signals are you watching in the AI chip space? Does this change your view on the future of AI hardware innovation? Let me know in the comments. And if you found this valuable, hit that like button. But here's what most people are missing while this plays out. This deal connects directly to a broader resource crunch unfolding in the tech world. Now, while Nvidia's $20 billion Groq deal is grabbing headlines, there's another equation being solved in real time. What if lithium dries up? The driest EV crisis yet. If you think today's story matters, you need to see what we uncovered there. Link in the description. Watch it next. Subscribe to the Resource Equation for weekly breakdowns like this. Next up, the global lithium supply chain under pressure and what it means for electric vehicles. See you in the next one. Quick reminder. This video reports and explains public information. It does not offer investment advice.